When a loved one passes away, the last thing anyone wants to deal with is a surprise tax bill. It's a stressful time. And honestly, the question of who pays capital gains tax on an estate just adds to the confusion. Well, today, we're going to bring some clarity to that. This is a complete guide for the 2025/26 tax year, and it's been developed by the absolute experts in this field, the team at the London-based accounting firm Total Tax Accountants. So here's our roadmap. We'll start by tackling a huge myth about tax when someone dies. Then we'll look at the executor's role and get into the actual numbers you need for the 2025/26 tax year. After that, we'll cover some really smart tax-saving tips and then switch gears to what you need to know as an heir. And finally, we'll wrap it all up with your next steps. Okay, let's dive in. Dealing with finances after a loss is just incredibly tough, and the fear of some massive hidden tax bill can make it so much worse. So let's get that biggest fear out of the way right now. This is the question, isn't it? It's the one that keeps people awake at night. You know that a property or some shares have grown in value over decades, and your stomach just drops. You're thinking, is HMRC about to swoop in and take a massive chunk of all that growth? Well, the answer, and I want you to really hear this, is a massive, resounding no. Let me say that again. In the UK, the act of passing away does not, by itself, trigger a capital gains tax bill. It's probably the biggest misconception out there, but it's a critical one to understand. So how does that work? It's all thanks to something called the probate value uplift, and this is the most important concept we'll talk about today. Essentially, the tax slate is wiped clean. Every asset in the estate gets a brand new value. It's market value on the date the person passed away, and that new value becomes the official base cost for any future tax calculations. All those years of growth, poof, wiped out for tax purposes. Okay, so if tax isn't due when someone dies, then when does it come into play, and who's actually on the hook for it? Well, this leads us right to the very important job of the personal representative. Now, a personal representative, or PR, that's just the official term for an executor named in a will, or an administrator, if there isn't one, basically has three big tax jobs. First, they sort out the deceased's final tax return. Second, they handle inheritance tax, which is a whole other topic. And third, and this is the one we care about today, they manage any new taxes that crop up while they're sorting out the estate. And here is the absolute crux of it. Capital gains tax only gets triggered if the personal representative sells an asset, say a house or some shares, and sells it for more than it was worth on the date of death. The tax is paid by the estate itself, not out of the PR's own pocket. If an asset is just passed directly to a beneficiary without a sale, then no capital gains tax is due at that point. Simple as that. Right, we've got the who and the when. Let's get practical and talk about the how much. This is your toolkit for the 2025/26 tax year, with all the key numbers you need to have in your back pocket. First up, your number one tool, the annual exempt amount. For the 2025/26 tax year, personal representatives get a £3,000 tax-free allowance. Here's a little pro tip for you. This allowance isn't just a one-off. It can be used in the tax year of death and for the 2 following tax years. So if the administration process takes a while, you could potentially use this allowance up to 3 times. Okay, what about the tax rates? Well, for 2025/26, they've kept it pretty simple for personal representatives. Any gain made from selling a residential property is taxed at a flat 24%. And any gains from other assets like shares are, you guessed it, also taxed at 24%. The only exception is if the assets qualify for something called business asset disposal relief, which brings the rate down to a much nicer 14%. So how do we put all this together? It's actually a pretty straightforward 5-step process. You start with the final sale price. From that, you subtract the value at the date of death. Then you get to deduct allowable costs, think solicitor fees or estate agent commissions. After that, you knock off your £3,000 allowance, and whatever's left, that's your taxable gain. You just apply the right tax rate to that final number. Now, we know the rules of the game, so let's talk about how to play it smart. This section is all about legal strategies to lower the tax bill, and a few really common traps you need to sidestep. And stay with me here. The next point might actually surprise you with just how much it can save. Okay, this is a real game changer.
It's a strategy called appropriation. You see, normally, the entire estate just gets one single £3,000 allowance. But if you legally transfer the ownership of an asset to the beneficiaries before you sell it, you can potentially use each person's individual £3,000 allowance. So imagine an estate with 4 beneficiaries. Suddenly, you can shelter £12,000 of gain from tax instead of just $3,000. It has to be done properly with a legal document, but wow, the savings can be huge.
Now that's not all. Here's where most people go wrong. Let's talk about the 60-day property trap. This is a big one. If the estate sells a UK residential property, you have just 60 days, that's it, from the completion date to file a special return with HMRC and pay the estimated tax. This is a super strict deadline, and if you miss it, the penalties and interest start racking up immediately. You really don't want to get caught by this one. We've spent a lot of time on the personal representative's duties. But what about when the assets finally get passed on to you, the beneficiary? This part of our guide is for you, explaining what you need to know once you inherit. The second you officially inherit an asset, your own personal capital gains tax clock starts ticking. The number one thing you need to burn into your memory is that your purchase price for that asset is that all-important uplifted market value from the date of death. That figure is now your starting point, your base cost. And here is a huge pro tip for every single beneficiary out there. The moment you inherit, create a simple tracker, just like this one. Write down the asset, the date of death, and that crucial base cost. Why? Because in 10 or 20 years, when you decide to sell, HMRC isn't going to remind you what that value was. Keeping a record now could literally save you thousands in overpaid tax down the line. Now let's look at another sneaky trap, this time to do with how property is owned. If a couple owns a house as tenants in common, the deceased 50% share passes through the will and gets that wonderful CGT uplift. But if they own it as joint tenants, their share passes automatically to the survivor. The survivor gets the uplift on the half they inherit, but their own original 50% share, its cost basis stays exactly what it was. This can lead to a really nasty tax shock for the surviving partner when they eventually sell. Whew, we have covered a lot of ground. So to make sure this all sinks in, let's just quickly run through the most important points and figure out what your next steps should be. So, if you remember nothing else, remember these key things. 1, no capital gains tax is triggered by death itself, thanks to that value uplift. 2, the personal representative pays 24% tax on sales made during administration, and they get a £3,000 yearly allowance. 3, as a beneficiary, your new cost price is that uplifted value. 4, you absolutely must watch out for that 60-day property deadline. And 5, smart strategies like appropriation can save you a fortune. Okay, now for a very important bit of housekeeping. The information we've gone through today is for general guidance only. Every family's situation is different and tax law can be incredibly complex. So please don't rely on this exclusively to make any big financial decision. Because everyone's circumstances are unique, this guide can't replace personalized professional advice. For expert help tailored to your specific situation, you should really speak to the team at Total Tax Accountants. You can reach them by phone on 01494 264826, or you can email them at info@totaltaxaccountants.co.uk. Thanks so much for watching.